Hi guys, I would like to illustrate the preparation of a handful of journal entries here, which came up as Chapter 3 sample homework. As opposed to uh, recording transactions directly into the accounts or T accounts as we did in Chapter 2, in a real accounting system, we chronologically record our transactions in a book called the General Journal. There are other books called special journals, but we'll stay with the General Journal here, which can accommodate any transaction at all, regardless of its type. So Rick Long invested $75,000 cash. So you just drop down and you know you're going to add to cash, which would require a debit. So again, you're not in the accounts, you're in a journal, which is like a diary of what's going on and what accounts will be affected by the transaction. So if you did your analysis, you know that the owner invests and we have the cash account going up and the capital account going up, so that we would have to record that entry by entering the month is already there, the date is already there, the day of the month, May 1st, the account to be debited. I don't think you can indent here. Okay, so let me come back to our law. Okay, so that takes care of the first transaction. Typically, we would like to see an explanation. I don't know if they're going to. Well, let's see. Cash owner investment. Yeah, I guess that's good enough. So that let me just make sure I got that right. They left more lines than was necessary, but let's just check the answer. Yeah, okay, so we got the hang of it, right? Now, mind you, these transactions would be posted to the ledger. That's the second step in an automated system. As soon as you click enter, the debit and the credit would automatically get posted to the specific accounts. Here, but all we're doing is the journal step of the cycle, so that if we paid $10,000 cash for a piece of equipment, we would go in there and knowing that we add to equipment, and that would require a debit. So essentially what we're doing is we're telling the system to put a $10,000 addition into the equipment account because it's an asset. The old-fashioned times we'd do this by hand, and we'd hand the journal to the posting clerk, and the posting clerk would then take that $10,000 and manually post it to the equipment account, as would the case be with all of these journal entries. So if it says paid, that's an indication that we're using cash, so we have to come over and enter it. A $10,000 reduction to the cash account, and we'll look for an explanation. We'll look for an explanation. We'll look for an explanation. Okay, so that would be what? The purchase of equipment, not on account, but for cash. Usually the explanation goes on the third line, for the line directly underneath the last item that was affected. So typically that would go up here on this line. Okay, I think I'm okay. Let's check. Good boy. Okay, so then it scrolls to the next transaction, auto equipment on account. You got to analyze your document, right? You'd get some sort of an invoice or a receipt depending on how you purchased it. So that would be on the 8th. And if we're on account here, we are bringing auto equipment into the business. So same stuff. So that would be the equipment account, except that we're buying it on credit, so that it would have a credit to accounts payable, and that amount is $1,000, as I see up here. Am I right? Okay, $1,000 on account. So let's get into that. Just click into the field and you're going to put your $1,000 debit, and then your that's 10,000, right? You want to put your $1,000 credit, bump, 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 right there, and then we'll look for the explanation. As I said, it looks like we're going to buy on account right here, so that's what we click. Okay, so that would be the transaction of the 8th. The 14th, we're earning some money here, so we gave the customer a bill or an invoice, and he handed over to you immediately. This is a cash revenue, so it's not a revenue on credit. So let's just check answer and make sure we're right. Good, and then go to the next. And here we are on the 14th, so that we'll put the 14 in there, analyze your entry. What happened? You got money, 1,800, so you're going to debit cash, asset goes up, and it is a fee earned, which would go to the revenue account, and we're talking $1,800. And then service revenue. Now again, these have to, we're not using a ledger in this little problem. However, this step comes first, and then it looks like I have to earned revenue on account. No, collected cash revenue, because we got paid right away. Okay, as I said, now typically when you click enter or post or whatever in an automated system, it's pretty much set up like this. All you have to do is click post or click enter, and the postings are done electronically, so you don't have to worry about transferring each debit and each credit. So let's just make sure that we did it right. And so far, oh, fantastic. Well, thank you. Okay, so the next one is we billed. Okay, now when you see that, when you see a billing, that means you performed a service. So it's like you performed a service for this Gregoire company, and you agreed to have that company pay you later. So you're selling your services on credit, which means that you have a right to receive $675 from this guy Gregoire, and we'll put the 18th in there, and you, of course, you're not getting cash, so you can't debit cash, but you're getting another asset called accounts receivable. I'm sure I explained to you before that is valuable because you have a claim against this guy for $675. It's unlike other tangible assets. But oops, that's wrong. So an account here, so that would be, it's still service revenue. It's recorded when the money is earned, even though we don't have the cash yet. When we collect the cash, then we worry about wiping out the account receivable. But right now, we're concerned with earned revenue on account, and I think that's the case. Correct? Accounts receivable. So we're adding to the asset accounts receivable, and we're adding to the service revenue account. Let's make sure we got it right. Check answer. Oh, yeah. We're terrific, aren't we? Okay. And then there's a withdrawal, the 20th. Okay. So for personal use, so we're looking to chase down that withdrawals account. And what we're doing is, instead of, like in Chapter 1, you would have gone right underneath the capital account or inside that capital house, and you would have reduced capital directly for the withdrawal, but we keep a separate accounting for it here. So we'll accumulate we're adding to the withdrawals account, which in effect would cause a reduction to capital later on in the cycle when we transfer the withdrawals as a negative into the capital account. So I think we're pretty much set with this. Let me show the explanations are way down yonder here. And owner withdrawal, that's it. Like I said, these typically are entered right underneath the last the last credit. So debits go first, credits go second, and that's it on this little exercise. So that didn't take long. But again, the next step would be to post the journal entries to the general ledger, which means a $75,000 debit would have to be transferred over to the cash account, which would add to the account itself. Same as capital. That credit would add to the capital account in the account itself. Notice that we made 2 debits into the equipment account. Well, after they are transferred to the ledger, then the equipment account would show up at $11,000. Okay, so let me just, I guess I can't proceed here until I check. I got my explanation in here. How well did we? Well done. Next question. Okay, I'm going to stop and then come back and do another one for you because we're 10 minutes in. Okay? Let me stop this guy here.